Once you define the multiple, the next step that you have to do is describing it and look at the distribution statistically. What is the average and standard deviation for this multiple across the universe in the market? What is the median for this multiple? The median for this multiple is often a more reliable comparison point. And how large are the outliers to the distribution, and how do we deal with the outliers is a very important issue. And throwing out the outliers may seem like an obvious solution, but if the outliers all lie on one side of the distribution, well, this can lead to a biased estimation. They usually are large positive numbers in our system, right? Are there any cases where the multiples cannot be estimated? Will ignoring these cases lead to a biased estimation of the multiples, right? For example, negative PE ratios, okay? Eliminating those in our analysis. Is that okay? Okay. If you go back to this graph over here, in 1998 or 9, right? When you work with PE ratios, well, you must have eliminated almost 30% of the companies out of your total universe, and you will be working with the profitable 70%. And then, is that a fair, unbiased estimation that you do? Okay, it's a serious concern. Okay. So you don't want to eliminate too many of them, and try to think about what's the consequence of using this biased sample. Okay, profitable biased sample, survivorship bias kind of things, right? Not really the survivorship per se, but profitable company bias. Okay, there you will suffer. And this, you have to think about it, okay? And then, are there any cases where the multiples cannot be estimated? Yes. How has this multiple changed over time? And that is why I showed you the time series graph of these multiples. Step 3 is analytical tests. This is a very interesting part of it. What are the fundamentals that determine and drive these multiples? Well, embedded in every multiple are all the variables that drive every discounted cash flow valuation. Turns out, cash flow and risk. And cash flow, further down the road, it's about the growth prospect. Growth, reinvestment, and then the profitability, right? Those are what matters. And then the risk as well, okay? And then, how do changes in these fundamentals change the multiple? The relationship between fundamental, like growth, and multiple, and the multiple is seldom linear. For example, if a firm A has twice the growth rate of firm B, it will generally not trade at twice its PE ratio. Why? Remember the mathematical formula for PE multiple. The growth rate goes into the denominator as a negative sign, okay? And that is not a linear relationship with the PE multiple. It is rational relationship. Rational in the sense that this is rational number, okay? 유리함수, rational function, okay? Rational functional relationship. It is not straight line, but some curvature will be there, okay? We have to be, careful about that. And it is impossible to properly compare firms on a multiple if we do not know the nature of the relationship between fundamentals and the multiple. And here comes, the determinants of current PE ratio, analytical test. Let's do it. To understand the fundamentals, start with a basic equity discount cash flow model. With the dividend discount model, using stable growth, one-stage growth model, okay? Let's analyze PE ratio, okay? That's price per share divided by earnings per share. And then EPS is like beginning of the period or last period's EPS, right? Last year's EPS, most recent fiscal year, that's the current EPS is being used, okay? Now, the price zero is what? Future dividend discounted at relevant cost of capital RE and assuming the growth rate G. You see that R minus G going on, and then dividend next year and dividend at the end of this year, right, should be dividend the previous year times 1 plus growth rate. Okay, that's what's going on in the numerator. Now what do? Numerator of the numerator should be numerator, and then combined with the denominator's EPS, that will be your payout ratio. And then the 1 plus G, okay, should be in the numerator, and then the denominator of the numerator, R minus G, should be the denominator of the whole number. So you see 1 plus G over R minus G going on. Now you see that PE ratio is a function of growth rate and risk and reinvestment needs, right? And then the growth rate, okay, is positively associated with PE ratio. Risk is negatively associated, but the reinvestment need, okay, well, that's something you have to think about further, okay? If you need to reinvest more, okay, that's what? Payout ratio will be smaller, okay? Reinvestment needs is higher, and payout ratio will be smaller, which means the PE ratio will be smaller. So that's why we have negative relation between the PE ratio and the reinvestment needs, okay? Of course, there's a tension between the growth rate and reinvestment needs. Okay, if you are a young growth company, then you need to reinvest much more. So your high growth potential will drive up the PE ratio, but it's not uniform because reinvestment needs will drive down the PE ratio as well. And then where does it stop? Nobody knows. Okay, so there will be a tension between these two. It's no surprise to have low PE ratio in the firm that has low growth potential, by the way. So people typically say, people in the industry typically say PE ratio is largely driven by the growth potential, even though there is a counterbalancing force coming from reinvestment needs, okay? Why is that the case? Look at the denominator, okay? Shrinking down the denominator will explode the number. So that's why. Anyway, example, a company ABC has the following characteristics. What should be its PE ratio based on the fundamentals? So payout ratio is 40%, growth rate of net income is 5%, and then the cost of equity is 15%. Now, just throw in to this analytical relation, you will be able to find out that the fair PE ratio has to be 4.2 times over here. Okay, you do this computation using the analytical relationship. So this kind of question I can give you in your final exam. As long as you have this kind of fundamental variables of your input, you can estimate what has to be their PE multiple. Now, what do you do with this? Compare with the company's PE multiple and see whether the current multiple is higher than this or lower than this. Depending on it, you can determine whether your company is overvalued or undervalued. So this serves as your benchmark efficient level of PE multiple, okay? If you have these inputs, right? The perfectly undervalued company you wish to find. If you were looking for the perfect undervalued asset, well, you wish to see it would be with a low PE ratio, which is cheap, and then with high expected growth in earnings, and then with low risk and cost of equity, and with high ROE. In other words, it would be cheap without no good reason for being cheap, okay? Then you have to ask yourself, is that possible? Kenya, okay? Could it be possible? The market is efficient, okay? Means like investors are competitive. All those free lunch opportunities must have gone away already, okay? The perfectly undervalued company, right? In the real world, most assets that look cheap on a multiple of earnings basis deserve to be cheap. In other words, one or more of these fundamental variables work against the company. It can have low growth prospect, or it's too risky, or the ROE is too small, and kind of things. There must be some bad reason why the multiple is low in the first place, okay? When presented with a cheap stock, for example, low PE, here are the key questions. What is the expected growth in earnings? What is the risk in the company? How efficiently does the company generate its growth? Okay, you have to critically understand these things and investigate. And 99% of the time, you will realize, hey, it deserves low PE ratio. There is a reason why, you know. If that is the case, then you have no chance of investment. It's not a value stock. Step 4, application test. Well, given the firm that we are valuing, what is the comparable firm? While traditional analysis is built on the premise that firms in the same sector are comparable firms, valuation theory would suggest that a comparable firm is one that is similar to the one being analyzed in terms of fundamentals. That means there is no reason why a company cannot be compared with another company in a very different business, different industry, if the two companies have the same risk, same growth, and same cash flow characteristics. Of course, most of the time, such companies will be in the same industry, but sometimes, the comparable companies can come from different industries, different countries, and things like that. And there are no two firms that are exactly identical. Then how do we control for differences across firms in the fundamentals? It is impossible to find an exactly identical firm to the one you are valuing. So in the end, we will use regression analysis. Univariate regression is most typical analysis we'll do it, application. Another is multiple regression, so that you can control for these fundamental variables and then still find out undervalued stocks, okay? So regression, okay, PE ratio and expected payout ratio, all Korean stocks are thrown out over here in 2015, I believe, okay? And I show you a scatter plot. Always your multiple is on the vertical axis, okay? Here is PE ratio of Korean companies, and then the horizontal axis, you need those economic fundamental variables. Here I used expected payout ratio. How did I get expected payout ratio? Because I have data guide, and there it gives me an expected payout ratio, the expectation by the analyst who are covering these companies, right? And then they periodically announce they anticipate such and such payout ratio for this company. And I also Windsorized, as you see, those extreme values were replaced by some 95th percentile figure like this, okay? And then I ran regression, okay? And then the white line is the regression line, and then red lines are one standard error up or down relative to this regression line, okay? Here I just hand drew these one standard error band like these, but in Python you can draw this one standard error up and down band using just purely computer based. Now standard error of the regression is here, root mean squared error, RMSE. That is the residual standard deviation, okay? So use that as a band. And what's the idea? Well, most of the stocks, or like 67% or something, will be located within this band. This band and this line confirms our intuition that the companies that have high expected payout ratio tend to have high PE multiples. Okay, this is more about dividend payout policy and how the company treats their shareholders. Would you like a company that treats the shareholders well by paying out dividend more, other things being equal? Okay, or would you like the companies that treat the shareholders badly by not paying the shareholders, other things being equal? Okay, well, if it is the same growth potential company, then you like the company that treats you better. Okay, shareholders governance, right? Stronger governance, better payout ratio, weaker governance, lower payout ratio. And then accordingly, the PE ratio is positively associated with it. Okay, you see that. So majority of the stocks are efficiently priced over here. So if I were the analyst for these stocks, I would say just hold, don't touch it. Okay, hold does not mean buy and get it. No. If you don't own the stock, you're perfectly fine. Don't do anything. Hold. 얼음 in 오징어 game, like a squid game. 얼음, don't move. Okay, that's these stocks. They are efficiently priced. Majority of them are efficiently priced. That's what perfect competition is about and market efficiency is about, right? There is no free lunch. But the stocks outside of this band, you have some chances. Okay, these stocks, well, I say these stocks are value stocks. They have strong fundamental. For example, these stocks, their fundamental is strong, but their PE ratio is too low compared to their fundamental variable. Then what should happen in the short run? Well, they deserve to go up higher. Okay, they deserve to go higher in the short future horizon. So what would you do with these kind of stocks below this band? Buy recommendation. What about the stocks above this band? Sell. The idea is that, well, why are you so high over here? Even though your fundamental is so weak, there must be some mispricing for you. Come down, man. So what would you do with this kind of stocks over here? Short sell. Or if you don't own the stock. Or if you own this stock already in your portfolio, my recommendation would be, sell it. Other things being equal, okay? So that's one way of identifying these investment opportunities using regression. People call this approach quantitative fundamentals, comparing across many different stocks, okay? Using regression approach, okay? Why did you learn statistics in your business major? To do this kind of analysis, okay, regression. And then you see your positive association is confirmed, looking at the coefficients being positive and t-statistic being very significant, okay? And then somebody may be troubled with the low adjusted R-squared number, but we don't care about adjusted R-squared too much in finance because there's tons of uncertainty and the randomness in financial market anyway. What we care about is the t-statistic over here. Does this explanatory variable have some explanatory power in the consistent direction with our analytical prediction? Analytical prediction comes from your analysis part in number 3 over here. Remember? Okay, this part. Analytical relation, reinvestment, the payout ratio, positive relation. Is it confirmed in the regression coefficient over here? This is what you have to do in your I-Core project, okay? Look at the coefficient and the positivity and negativity Is it in a consistent direction with the analytical prediction? If so, use it. Otherwise, don't use that regression result. Okay, and then statistical significance. Okay, is it significantly different from 0? Then use that relation. Otherwise, drop it. Okay, you have to do a lot of this kind of statistical analysis in this project. And you can see that in this graph. Good company is not necessarily good stock to invest. Okay, for example, the companies that has strong fundamental. Okay, well, those are strong fundamental companies. They are good companies, but good stock, and those are the ones below the standard error line. Okay, these deserve your money to invest. But if the company is located over here, I would not jump in, because it's just a good company, not necessarily a good stock. They are correctly priced, efficiently priced. Don't touch it, just hold it. Hold your autumn kind of things. Don't move, okay? That's the situation here, okay? Good stock, good company, they are different things. So this is very important for your value investment idea. Okay, thanks for watching. See you in the next video.